Every financial crisis looks different on the surface. Different headlines, different triggers, different explanations. But look deeper, and a pattern begins to emerge. Markets rise higher than expected. Debt expands beyond comfort, and suddenly collapse. And just as suddenly, rescue. Liquidity appears. Rates drop. Systems stabilize. So here's the question no one asks. If crises are unpredictable, why do the solutions always look the same? And more importantly, why do those solutions make the system even bigger after every collapse? What if collapse isn't just failure? What if it's part of the blueprint? Before central banks, financial systems were fragmented. Banks operated independently. Currency systems varied. Crises were frequent and often brutal. When panics hit, there was no safety net, no coordinated rescue. That instability led to the creation of central banks, institutions designed to stabilize economies and act as lenders of last resort. At first, their mission seemed clear: prevent collapse, but over time their role expanded. They didn't just respond to crises, they began shaping the conditions that created them. The early idea behind central banking was simple. When financial stress appears, inject liquidity. When economies overheat, tighten conditions. A balancing act. Like cause and effect introduced a new dynamic. Lower interest rates encouraged borrowing. Borrowing fueled asset growth. Asset growth created optimism. Optimism drove more borrowing. Each intervention to stabilize the system also expanded it. And over time, markets began to rely on that support. As economies globalized, central banks gained more influence. Interest rates became a powerful lever. Money supply became flexible. Financial markets began reacting instantly to policy decisions. During downturns, central banks stepped in aggressively. They lowered rates, purchased assets, injected massive liquidity into the system. These actions prevented immediate collapse. But they also introduced a dependency. Markets began to expect intervention. Risk-taking increased, because the downside appeared limited. Over time, stability itself created fragility. Low interest rates encouraged excessive borrowing. Asset prices rose beyond fundamental value. Debt expanded across governments and households. The system grew larger, but also more sensitive. Even small disruptions could trigger instability. And when stress appeared, central banks faced a dilemma: allow correction and risk collapse, or intervene and increase long-term imbalances. Most chose intervention. When crises finally occur, they often follow a similar sequence. Asset prices fall, credit tightens, confidence drops. Then comes the response: liquidity injections, emergency lending programs, interest rate cuts. The system stabilizes, but at a cost. Debt levels rise further. Central bank balance sheets expand. Markets become even more dependent on support. Collapse is avoided but not eliminated. It is postponed, reshaped. Each crisis leads to new policies. Stronger regulations, more oversight, improved risk management. But the core structure remains unchanged. System still depends on credit expansion. Markets still rely on intervention. Debt still accumulates faster than underlying growth. So the cycle repeats. Each time, the scale increases. Each time, the margin for error shrinks. Today, central banks operate on an unprecedented scale. Trillions in asset purchases. Global coordination during crises. Markets reacting instantly to policy signals. When economic stress appears, liquidity follows almost immediately. The pattern has become predictable: expansion, overextension, correction, intervention. Each cycle builds on the last. Each time, the system becomes more complex and more fragile. First, central banks don't just respond to crises. Their policies shape the conditions that lead to them. Second, repeated intervention can stabilize systems short-term, but increase long-term dependency and risk. Third, what appears as collapse may often be controlled, managed, rather than allowed to fully reset. Financial systems rarely fail in a single moment. They evolve, adapt, stretch over time. Central banks play a critical role in that process, balancing stability with expansion. But every intervention carries consequences. The question isn't whether collapse can be prevented forever. It's whether delaying it makes the eventual outcome more severe. If you want to understand how central banking and financial cycles really work, subscribe for deeper breakdowns. Because sometimes what looks like rescue may actually be part of the design.